Okay. The reason this is important is it drives the probability calculations down here. And I'll show you why the probability calculations are so important later on. Now, to do this, the spreadsheet is really critical because, unless you're an absolute mathematical genius, doing probability calculations in your head is just about impossible. I certainly don't want to touch it. It just gets so hard. But the spreadsheet makes short work of it. I've already put the time in for getting the calculations right. Hopefully everything works, and should be a pretty decent calculation for you. Now, the analysis section over here takes all the data that you entered and breaks it down to all the numbers that you want to see relating to this particular trade. The net credit per contract is 40 cents. If we're doing 10 of these Iron Condors, that means the net credit for the position is actually $400, $40 per 10 of them, for 10 of them. Now, the max risk is calculated by taking the distance between the two strikes, the short strike and the long strike, and basically calculating that out, $2.50, and then offsetting it with the credit that you get for creating this trade. So $2.50 offset by 40 cents means that you've got a risk of $2.10, or in this case, 10 Iron Condors would give you a total risk of $2,100, which coincidentally is also our margin. Now, that's an important thing to know here. What are we going to get based on the margin? So if our margin cost is $2,100 and our credit is $400, the max return possibility that we can get on this particular trade is 19%. The max return probability basically of getting into this trade, and this is driven very much by this forecast volatility number here. The max return probability, the probability that we're going to have the price end between $75 and $85 is 78.87%. Now, earlier today I analyzed this, and at that time the market hadn't quite gone up as much, and I estimated a 19% forecast volatility. You can see that that changes the numbers very, very slightly. I'm actually going to play with the numbers and show you some things in just a second. But this is going to tell us why, this is going to tell us a lot about the trade. So I'm going to put this back to 20. Now, I also calculate out what the break-even high is. As long as the price of the stock stays below $85.40, we're going to break even or do better on this trade. If the stock goes below $74.60, we're going to, stays above $74.60, we're going to break even. The chance for break even or better is 82.32%. And that's taking into account a lot of things. And this is, I consider this a slightly better estimate than what you're going to see out of a lot of platforms that just take the implied volatility of the option and do a probability calculation off of it. And I have a lot of people asking me why I just don't use the implied volatility of the option for my numbers. Well, there's a really good reason for that. Implied volatility is what we're trading against. If the forecast volatility is lower than the implied volatility, you need to see what the chance of the trade going against you or for you is based on the forecasted volatility. If the implied volatility is higher than that, essentially baked into the numbers that you're seeing right here, then that means that this trade is going to be a positive trade. It's going to have a positive expectancy. If the implied volatility is lower than this forecast volatility, then we're going to have a negative expectancy, basically meaning that if we did this trade over and over and over again, eventually we would be losing. So that's one of the things we really want to know about this trade. Based off of this number here, the forecast volatility, we've created this probability curve. This basically says what is the chance of the stock price landing at one of these prices on the close of the expiration date for the option series. And then what I do is I take every one of these points along this curve. Obviously in this particular case, the highest probability is that the price is exactly the same as it is right now. And then there's a little chance that it might go up and then down, or down and then up, or just flat and then down. But you can see how things are going to center around the current price at the highest probability and then curve down to each side as you get a little further from that price, until you get some very, very low probabilities that that price is going to get hit. At each of these points, there's 100 points across this, it samples what would the value of the trade be if the stock did expire at that price, or the options expired with the stock at that price. And it takes that, and in this case, we've got $2,100 worth of losses way off here on the left. And there's a very low chance that that's going to happen. So we basically multiply the value of the trade at that point times its probability, and we do that for every single point, and we sum them up. And I know this sounds horribly mathematical, but you sum them up and then divide by the total samples of probability, and it gives you a weighted average of what this trade is going to do. That weighted average is what's called expectancy. To put it in a different way, expectancy could be described as what is the average return that this trade would have if I did it in the same conditions, in the same setup, same market type, but not the exact same market movement of the stock, but the same market type 100 times. We did that trade 100 times in the future, and we averaged out the return of every one of those trades, all of the winners, those few losers. What is my expectancy? What am I going to expect to get for a trade result on average? And in this case, you can see that the max return probability is 19%, but our expectancy return probability has dropped down to 7.77%. It was actually higher than that earlier today. That some of this may be ineffective, just to close price, things like that, but it was actually much higher than that, about 12% earlier today. On average, in the future, you're going to make $163 in this trade, giving us 7.77% return on this trade. Now, I have another number here, which is expectancy, just normalized down to a daily value. The reason I put that there is I want to give you the ability to compare a trade that's 40 days long to a trade that's 7 days long. This number right here should stay steady across that, or to be comparable across that. Right now, we're going to make roughly 0.6% a day on this trade that we're holding for 13 days. Now, this number isn't what I would consider a great expectancy number. Earlier today, it was a much better expectancy number, but we kind of got caught with some prices shifting around at the end of the day. Also, if I change this down to 19%, you're going to see that expectancy go up. The reason for that is the prices are going to move around less. They're going to stay in a tighter range. There's a less chance that they're going to move outside of the profitable range in our Iron Condor. And because of that, that means that we've got less samples where we're losing money and more samples where we're winning money. Now, I've had people ask me, why do I sometimes see negative expectancy when I've got this curve right in the middle, blah, blah, blah. It's because the probability, and the market's just closed, the probability that the trade is going to close outside of these, this winning zone is higher if the forecast volatility is higher. Now let's take a quick change here and say that, let's say the Dollar Tree actually had a forecast volatility of 30%. It normally traded at about a 30% volatility, and we think that that's normal, we think that's expected. You put 30% in here, and boom. You'll notice how the curve is now predominantly outside of this winning zone for the Iron Condor. It means we've got a lot greater chances of losers. And these losers, by the way, are much bigger than the winners. We have a 61% chance that the trade is going to come in here. But the losing trade is much, much larger than the winning trade. And they, you know, even if we win 6 times out of 10, Those 4 times out of the 10 that we lose are going to wipe out our profits if we're dealing with a volatility like this. Now, luckily on Dollar Tree, the volatility is closer to 20%. Now, we have roughly 8 out of 10 times, we're looking at 78% probability of max return, 82% probability of break even or better. So roughly 8 out of 10 trades are going to be in our favor on this. Now, that's not taking into account any technical analysis. It's not taking into account any prediction. It's just flat out, what are the probabilities based on the volatility estimate that you did. 8 out of 10 of these trades are going to be in our favor, and that's going to be enough to make more money and cover for any losses that we might take. And that overall makes for a good trade. I like to see a good positive expectancy. I would rather see this around 0.8 or even 0.9, but that's just what we've got right now in the market. So I can't change the market. It is what it is. Now, that explains my basic approach on expectancy. I want to see a good positive expectancy here. I want to see a trade that also has a high probability of finishing in my favor. And I actually have a little bit of a checklist coming up. So let me reduce these. Okay. Once we've done the analysis, we need to evaluate the results. The expectancy needs to be positive for me to even consider this trade. This is basically saying, do you have an edge in the trade or do you not have an edge in the trade? I look for a high positive daily expectancy, ideally one above 0.9%. I would actually take that 0.6%, but I'm not as excited about it. I probably wouldn't put as much money into it. 0.8, 0.9, those are kind of the thresholds for being really aggressive with that trade. Higher on the daily expectancy is better, but beware of the ones that are too high. You know, if they stink, if they look too good to be true, they probably are too good to be true. Just, you know, don't get too aggressive on these things. You know, we want a nice, consistent results. That's the goal. And sometimes ones that have very, very high expectancies, massive potential for a large return, oh, people know something out there that we don't. And those may be riskier than we think. I also look for a couple of things. A max return probability to be as high as possible. Now, I like to see it greater than 75%. That basically means 7.5 out of 10 trades are going to go in our favor. Now, one thing to point out about all of the analysis that we just looked at, and especially those return probabilities, while we're managing the trade, we can always adjust them. Every time you adjust a trade, you buy the chance, the likelihood that the trade is going to go into your favor by selling off a little bit of your profit. You give back a little bit of profit to make the adjustment, and by doing so, you increase the probability the trade is going to go in your favor. So there are things that we can do to actually increase the possibility that the trade is work for us. But right now what I'm talking about is just entries and an evaluation of the trade as a general thing. Now, the max return probability, high 80s to 90s is absolutely great. You know, this is a probability the trade is going to make the max profit. I like to see those as high as you can get. 75 cents good, 75% is good, 80% is better, 90% is outstanding. Now, when you place the Iron Condor trade, really try to get filled around the midpoint price. Try to get filled as close to the analysis price as possible. But that won't always happen. If you have patience, you put the trade out there and just let it sit, and I'm talking potentially for hours, maybe even days, it will eventually get filled up at that midpoint price. Just let it happen. You can get more aggressive about the entry by reducing the amount of credit that you're going to get through the trade. But every time you do that, it has a double effect against you. One, not only you're just getting less money for the trade and you're going to make less profit, and two, you have less credit to offset the risk of the trade, which means that your ratio of risk to profits is getting bad fairly quickly. So don't let the trade get away from you too much, and don't chase a price down too far. If the trade can't fill you at a place that's close to your analysis point, maybe 5 cents away, then it's probably not as good a trade as you want. Just let it go. You know, my strategy with these is to put a lot of them on, manage a lot of them at the same time, and overall, you know, overall, as long as you set them up well, got good prices going in, they're going to work out in your favor. Now, managing the trade, I'm going to have to do another class of managing the trade. I'm also talking about doing another class on expectancy because I know that that's a confusing topic. But the basic goal of this trade is to let the options expire worthless. The goal is to keep your full credit. Now, we all know that Iron Condors do need management. They need to be watched and adjusted periodically. I don't have time to do that today. We'll do that in another class, but we'll go over that whole thing at another class. Looking forward to having everybody back again. Now, just want to say thanks for joining us. I'm going to hand this back to Doug Reagan. The spreadsheet that we went over is going to be available to anyone who joins up to the newsletter. As soon as we have everybody in, and I please encourage you to get into the newsletter tonight. We'll probably be sending this off tomorrow, and everybody can use it as a tool. I update it periodically. I'll send out updates to everybody, and I'd love to get some feedback because it's kind of been my baby for a while, and I'm hoping